Well,
Hello and welcome to today's Tax Intent topic, inheritance tax planning. This webinar was recorded on 24th January 2020, so before Sajid Javid's first budget on 11th March. My name is Stephen Barrett and I'm a partner at James Cooper Creston, specialising in advising clients on wealth protection and succession, especially inheritance tax. This session aims to provide information about the tax, how it is calculated and what reliefs are available to assist you in planning to reduce the burden of the tax on an estate, whether it be your own or that of a family member. It is not possible to cover all aspects of inheritance tax in a single short webinar, but I hope by giving an overview of the key exemptions and reliefs and signposting key issues that you will be better informed to start to address this major tax. As you may know, it was Benjamin Franklin who famously said that in this world nothing can be said to be certain except death and taxes. In more recent times, however, Chancellor Sajid Javid has revealed scrapping inheritance tax is something that's on his mind, and he understands the arguments against the tax. What changes that will follow, and critically when, cannot be predicted, so this webinar focuses on things as they stand at the time of recording. What is inheritance tax? Before we look at the detail, what is inheritance tax, or IHT as I shall call it from now on? IHT is a tax charged 40% on the estate, the property, money and possessions of someone who's died. It can also be payable on the value of lifetime gifts. The most common situation in which this occurs is where a person making a gift to a member of their family dies within 7 years of making that gift. It is true that a taper relief can reduce the IHT payable on the gift, but importantly not the value of the gift itself, as many believe. But if the donor survives the gift by 7 years, it is exempt from IHT altogether. This is a key feature and opportunity of the tax, and by planning early and over a period of time, the amount of IHT can be substantially reduced. Different IHT rules currently apply to lifetime transfers into trust, but unfortunately there is not sufficient time to cover trusts in this session. Exemptions. Gifts within a marriage or civil partnership are exempt from inheritance tax without the need to survive 7 years, and such transfers can be helpful in reducing or avoiding IHT on the first death, as well as capital gains tax and income tax. But the recipient will pass away at some point, so longer-term IHT planning might still be required. There is an exemption for gifts to charity and a further exemption that is underused, an exemption called normal expenditure out of income. For a gift to be exempt as normal expenditure out of income, it must, as you might imagine, form part of the individual's normal expenditure out of their net of tax income, i.e. there needs to be a pattern, while still leaving that individual with sufficient income to maintain his or her standard of living. There is currently no limit to the level of this exemption and no survivorship requirement. Good record keeping, however, is essential, as HMRC will check the position carefully. Finally, there are, shall I say, a modest annual exemption of £3,000 per year and a small gifts exemption of £250. Agricultural and business reliefs. Where the deceased owned an interest in a farm, farming business or another type of business at the date of their death, its value can be reduced by up to 100% if all the many necessary conditions are met. It is not possible to list all of those conditions here, but it is worth noting a key situation in which relief will not be due. This is where the business is one of wholly or mainly holding investments. An example of this would be a property investment business, whether commercial or residential property, and this could be the case even if the management of the property requires a good deal of time. As you can imagine, this is a contentious area which can, for instance, particularly impact diversified farms and landed estates which use surplus farm property to generate non-farming income such as rents. Another example is a company that has been historically a property development company, but which over time has wound down its development activities and now mainly or wholly rents out property. All is not necessarily lost, however, because in the right circumstances, restructuring the business can generate at least some measure of IHT relief. Nil rate bands. Once reliefs and exemptions have been allocated, executors can then deduct a nil rate band of £325,000 from the estate's taxable value. No IHT has to be paid on this amount. It is not, however, always as straightforward as deducting this value from the value of the date of death. Where gifts have been made in lifetime which have not yet become exempt under the 7-year survivorship rule, or are not otherwise exempt, the nil rate band is first allocated against those gifts in chronological order. It is only the remaining nil rate band, if any, that can be set against the estate as it stands at the date of death. Planning early can therefore be really important, especially where appreciating assets are concerned. In addition to this nil rate band is the residence nil rate band, which currently stands at £150,000 and rises to £175,000 for deaths after 5th of April 2020. It is a complex allowance, but in summary, it is set against the value of residential property left to direct descendants on death. In certain cases, it can also apply where residential property is no longer held at the date of death, perhaps because the deceased had to sell their home on moving into care. In practice, the residence nil rate band is often not as generous as it sounds, because it is tapered down if the estate of the deceased is worth more than £2 million before, and it is important here to emphasise before, deducting exemptions and reliefs. The reduction in the residence nil rate band is £1 for every £2 of value in excess of £2 million. It therefore tapers away very quickly once the threshold is exceeded. By monitoring asset values and with careful planning, it is often possible to mitigate or even avoid the impact of this tapering effect. Finally, on nil rate bands, where one spouse or civil partner dies and the full amount of their rate bands wasn't used on their death, a transferable amount is available to the surviving spouse's estate, or indeed the surviving civil partner's estate. Capital gains tax. When considering any tax planning during lifetime, there is likely to be more than one tax to consider. In the case of IHT planning, this is particularly the case with capital gains tax. Where an asset is gifted from one family member to another, this is treated as a disposal at market value for capital gains tax purposes, which can result in a tax charge on that gift. There can therefore be a conflict between IHT and capital gains tax. This can be particularly troublesome because the person making the gift might then not go on to survive the necessary 7 years for the gift to become IHT exempt, so both taxes can still be payable. Working with suitable valuers and acting early is essential in managing this risk. Other considerations. There are many other considerations associated with IHT planning, but I want to focus on just a few. The first is that the most important piece of information is not known in advance, i.e. the date of death. It is therefore not possible to plan the 7-year period with any degree of certainty, and so assumptions and judgments need to be made at each stage. Key to any IHT planning is often starting early, and perhaps small, keeping the position under regular review, making gifts over time as appropriate, and discussing things within the family as well as with advisors. Then there is the question of financial security and independence, especially with increasing life expectancy, which can bring more complex and costly needs in later life in both income and capital terms. There can also be other considerations, such as the control of assets, the age and suitability of the recipient, etc. On all these points, a team approach will often provide the best outcome and will necessarily require the involvement of the accountant, wealth manager, and solicitor. Finally, it must be noted that in 2019, the Office of Tax Simplification produced a report on IHT and recommended certain changes that would impact how the tax operates. Whilst one cannot predict the future of tax legislation, it is important that any such proposals are borne in mind. Well, that is all I have time to cover today. I am Stephen Barrett, and I hope that you found this short webinar interesting and useful. We welcome your comments, so if you do have any feedback, please do get in touch with us. We are also here to help. Thank you for listening, and goodbye.